Minister Kang, uh, Managing Director Ravi Menon, distinguished guests. Let me first thank Ravi for that very kind introduction. And I wish I could take him everywhere I go to introduce me. Um, it's a great pleasure being here to give the MAS lecture. And so I thought about what I would say, and I was looking for a single pressing theme that I would talk about. And as some of you may know, and as Ravi just pointed out, I've been talking a little bit about uh, the unconventional monetary policy and its spillovers to the rest of the world. But I thought that's sort of old news. Perhaps I should reflect on something else. And I thought that at this point, given the kind of deregulatory moves that are happening across certainly in the United States, it might be very useful to think about why we have undertaken the regulations we undertook post-crisis, what we've learned, where we seem to have covered our bases, and what seems to be still left open. And finally, some of the debates that we're having right now. What's the appropriate role of monetary policy in aiding the quest for financial stability? What is the role of macro-prudential regulation? And I think something that we will see more debate about, what is the role of international agreements, such as the kinds that we have in Basel? Is it something that we need to have, or is it possible to let countries determine their regulatory structures on their own without having the centralized focus? So let me start by just telling you, the main themes, and then go into the details. I would argue that broadly, the trends we've seen in the regulatory approach as a result of the crisis and post-crisis has been that we've moved from a focus on credit to also bring in liquidity. One of the big issues during the global financial crisis were not just whether people had made bad loans, but as a result of those loans, liquidity in the system itself dried up, interbank lending, because there were concerns about the quality of balance sheets and so on. So systemic liquidity, the possibility of fire sales, the possibility, therefore, of an overhang of assets on the system, of bad assets on the system, is something that we've paid more attention to. Second, from a focus on specific institutions, we have started thinking much more about the system. And the point here is, increasingly we see just ensuring the banking system is safe doesn't necessarily mean the system is safe. And concerns in one corner of the system can spread throughout the system via the markets. And so, again, you have to take a systemic approach. You can't look at an institutional approach. And of course, that also means that the micro-prudential bank-by-bank analysis has given way to a more macro sense, which also means macro-prudential measures, as well as trying to think about what role monetary policy should play in financial stability. So given these broad trends, I'm going to talk about what we've done, why we've done it, and what we need to do still going forward. I want to spend a little bit of time, given the audience, now only some of you are academics, I want to give you a sense of the academic literature on why we regulate banks. Sometimes we go ahead and do it, but you want to ask, why is it that banks specifically need regulation? Why don't we regulate firms in the same way? I want to talk a little bit about that. And then I want to go into the various forms that microprudential regulation has taken. Talk a little bit about regulatory incentives. Having been a regulator, but now sort of having given up my membership, I can talk a little bit about some of the incentives in the system and essentially ask the question, who regulates the regulator? And how do we make sure the regulator is on the straight and narrow? I want to talk about these three special topics. Should monetary policy be sensitive to financial stability? What role is there for macro-prudential regulation? And should regulatory requirements be harmonized across countries? I will try and keep all that within the next 20-25 minutes or so. So let's start with why regulate banks. And there are five possible reasons. I will go into the details of each one of them a little bit. The first is that the structure of banks makes them fragile. Banks are levered institutions, highly levered institutions, 10 to 1 for the most part, and that structure makes them fragile to small risks. That's the reason we do it. So that leads to the question, why are banks structured in such a way? Why can't you have all equity financed banks or banks with much lower levels of leverage? And I'll talk about that. Second reason is the reason that Ben Bernanke, Milton Friedman focused on, which is that banks are central, important utilities in the system. And as utilities, once they collapse, essentially economic activity can come to a halt because of their importance. Not just because of the fragility, but in addition because of their importance. You want to make sure that bankers internalize their importance to the system and do the right thing. A third reason is not only are they important, but they don't necessarily have the right incentives to behave. So bankers have, on occasion, perverse incentives, and that's an additional reason to regulate, because there are bank-specific aberrations in behavior that become problematic. A fourth reason is that authorities can bring to bear powers that the banks simply don't have, and therefore have the power of rescue. For example, the central bank has the power to create money. And by creating money which can be used in final settlement of debt, essentially it creates liquidity. Because the central bank can create liquidity, it's an important factor if in fact there are liquidity shortages in the system. And the final reason for why you regulate is because you have the temptation to intervene. As a regulator, because you intervene, the market understands this and takes advantage of it, which means you intervene even more to prevent the market from taking advantage of you, right? So a classic example is if the markets believe strongly that there's a central bank put, when the market swoons, the central bank will come and intervene. That means that the central bank then has to do more intervention, not ex post, but up front to make sure that the market doesn't take the risks which require central bank intervention. And that's sort of the fifth reason. So let me walk quite quickly through this. I will skip through most of the academic papers here, but highlight a couple which I think are important and make sense. So the traditional reason for regulation is banks are essentially entities that finance illiquid assets with demandable liabilities, right? And the main reason why these liabilities sort of are important is to some extent because I think summarizing this literature really, it boils down to two things. One, you want liabilities which have certain value, which have a certain value which are not subject to any uncertainty. Demand deposits have that character, and therefore they can be used in payments, they can be used as easy liquidity. However, the entity offering those demand deposits then becomes liable potentially to uncertainty about its value and then runs. So when you issue a really hard claim, it becomes liable to runs. And so in a sense, in the bank's production function, which is of producing these hard claims, it itself contains within it the potential for bank fragility. Now, saying the bank shouldn't issue demand deposits is like saying the bank shouldn't be doing its work. It shouldn't be issuing money-like liabilities, raises the question, who will do it? A new emerging answer is central banks will do it. Central banks will issue demandable claims, central bank will issue accounts to the entire economy, and the central bank will do that essential banking function. So that leads to the question, well, why don't we replace banks with the central bank? The central bank can do all this money function, banks can get out of it. Well, the academics, in fact, Doug Diamond at the University of Chicago, and I have another sort of rationale for why it's good for banks to do it. It's also a cheaper way for financing. If the banks are ultimately going to lend to projects, to businesses, to retail investors, etc., issuing demandable liabilities is often the cheapest form of financing for the banks. And it's not just their money-like character, but they're also, because they're runnable, they're very hard liabilities. And that reduces the cost of financing to banks and allows intermediation. Regardless, the basic point is it's not easy to get rid of this bank function. And if the central bank is going to do this function, the central bank has to ask the additional question, how do I get the money out once I take in all the deposits in the economy back to financing real business? Am I going to start financing, finance companies long term and then they get the money out? What is the process of intermediation once the central bank takes in all the deposits? That's a question very few people have answered when they talk about central banks providing these deposits. Now, the fragility from doing these kinds of activities essentially can materialize. The old view is that you'd have sunspot panics. What is a sunspot panic? If you remember the movie Mary Poppins, remember the movie Mary Poppins? The child is going into the bank and the child wants the tuppence or whatever, and the bank there's a run on the bank because there's a belief the bank is not good for that money, right? That's an example of a sunspot panic. Something happens and the bank falls as a result. Now, most people believe that's not really how banks fail. How banks fail is not because the uninformed depositor suddenly gets scared about the bank and forms a line before the bank and you get bank runs, something that did happen during the Great Depression. But really today what happens is the informed interbank lender or the hedge fund, which is in the market every day with the bank and knows the bank is fragile, starts the run on the bank. And it's the interbank institutional run which essentially brings down banks, not the retail depositor run. So this is really informed runs once you understand that the bank is fragile. And one of the interesting papers on this, Larry Ball wrote a paper on the demise of Lehman. One of the interesting things he points to is when Lehman was run, I think in about the second week of September 2008, essentially its equity had been eroded to just $3 billion. So it was run essentially at the point it became insolvent. And that's precisely the nature of the run in banking systems, happens when the system becomes insolvent, not just because somebody takes fright and runs for their firm. So in that sense, the bank is actually quite a stable institution, but when the bank becomes insolvent, the runs take place very quickly. And that's the nature of the modern bank. So one reason to regulate banks is to make sure that they're not so fragile. One way we do that is by demanding they hold capital requirements. The point of this literature is to saying there's a cost to capital requirements, because the more capital we require banks to hold, the less they're able to do their fundamental function of issuing demandable liabilities. A second reason to regulate banks is because they're really central to the system of payments and credit. The payments view was the famous view espoused by Friedman and Schwartz this is Milton Friedman, in his 1963 book on the monetary history of the United States. Essentially, they argued that the reason we had the Great Depression was banks failed. When banks failed, the monetary system collapsed, people couldn't make payments, and that is why, because monetary aggregates collapsed, we had the Great Depression. Now, Ben Bernanke expounded on this a little more and said it wasn't because the monetary system collapsed, but banks are also very important in lending. And in those lending relationships, there's a lot of information embedded. So when the bank collapses, that information is lost. And anybody new coming into the process doesn't know who's creditworthy, who's not creditworthy, especially in a system where you don't have these records publicly maintained. And so because banks failed, firms could not get credit anymore, and he shows that in the areas where banks failed, credit started falling precipitously. So Ben Bernanke's view was it was the local lending collapse. There's a lot of papers which established that. A third view is that one of the problems when you have bank distress is the bank starts selling a lot of assets in the market. That depresses the price of that asset sometimes way below fundamentals. Many of you may have remembered in the 2008 panic, there were assets that today you wish you had bought, which were trading at a fraction, 10, 15, 20 cents on the dollar, because they were being sold at fire sale prices, right? So the fire sale externality that when a bank loads up on a certain quality of asset, it doesn't internalize the fact that if it actually needs to raise money, it has to sell it at a time when everybody else is selling it. And therefore, the system can load up too much on an asset, resulting in large fire sales, a deep depression in prices for those assets. That's another reason why we think regulation is important, because you could have fire sales and then contagious runs. As banks are fundamentally sound, but because of illiquidity in the market, because there are not enough buyers, prices of assets fall significantly, and essentially they get hit by runs. A third reason to regulate banks is that they're not just utilities, but they're also bank-specific aberrations. And let me talk about one rather than going through this through this list. One of the aberrations that happens with banks is what the chairman of Citibank, Chuck Prince, talked about when he said that most famous quote before the financial crisis, we have to dance while the music's playing, and the music's still playing, so we're still dancing, right? And what's the point there? The point is that in a sense there is a banking franchise, and banks feel compelled to participate in that franchise, to participate in making loans. And interbank competition can sometimes erode credit quality. Everybody's running to make the loan. This is, in every country, at certain periods you have this phenomenon. There are very few sound credits around, and everybody's running to lend to them at abysmal sort of spreads, because you want to be in the business, because you want to be sort of managing your franchise. I remember asking Chuck Prince many years later about why they did that, and he said the real problem is if I stopped, I would lose my people. My people were being hired away all over the place. I could not tell them I don't want to make these loans, because essentially I was telling them I want to end the franchise. So to keep the franchise, I needed to keep making the loans. And essentially credit quality eroded. I want to show you one slide here just to make the point. One of the things that I have done with a bunch of co-authors is looked at the distance between a bank and its borrower. And one of the most interesting findings is that the distance between banks and their borrowers has been growing over time in the United States. And why has that been growing? Because technology has made it easier to lend at a distance, to communicate at a distance, to do credit evaluation at a distance. All that is good, right? So what you see here is that the distance between borrowers and the nearest branch has been increasing even in the last 15 years or so. That's the graph. But you see that peak in the graph? What that says is before the financial crisis, you had a substantial increase in lending at a distance. A substantial increase in lending at a distance, post-financial crisis has collapsed back. Now, why would you have that? One reason you would have that is banks are running out of lending opportunities nearby. And they say, everybody's lending, everybody's growing their books. Well, let's take a plunge and lend at a greater distance. And so they move further out to lend. Now, look at the second graph, which actually shows on the top is the lending in areas which have a lot of competition at the branch level. Okay, so a low Herfindahl index implies a lot of competition. In the areas where they had a lot of competition, they went out on a limb to lend at a distance. The lower graph, the green one, is the areas where the banks had more of a monopoly position locally. There they didn't go out. That's again suggesting, and you see that peak again and the trough around 2008 for the banks that were in the more competitive areas. That's suggesting basically that there are additional aberrations in banking. In most other industries, competition makes you improve quality. In banking, competition makes you reduce quality to some extent on your credit portfolio. And that's a bank-specific aberration which sometimes regulators have to deal with. There are many other bad things that happened in the lead up to the crisis. For example, in some of the loan securitizations, banks seem to have no idea about the existence of second liens on the mortgage that they were selling. That is, there was equity, 20% listed for that. Turned out that 20% of that 20%, 10% was lent by somebody else, and they had no documentation of that. But the point is that in banking, it is quite possible to make something which looks like a good loan, but effectively, as you go into these periods, it's actually a loan of fairly poor quality. Let me talk about this, which is fairly obvious, that central banks, the authorities have powers that banks do not. We saw it in operation in the crisis. The lender of last resort function, the ability of central banks to expand their balance sheets significantly in order to essentially liquefy assets that had become illiquid. The ECB did this, the Federal Reserve did this. This was an important factor which prevented the recession from turning into the Great Depression. I think there were a variety of very clever instruments that were used, very important. Another factor behind the banks was the fact that ultimately governments have taxation ability. And in the financial crisis, the governments were drawn in to back the banks. Interestingly, and this is where a lot of people complained about the austerity in the UK, I thought one of the reasons behind the austerity in the UK post-financial crisis was simply that the UK was one of those areas where the banks were so much larger than the size of the government. And in some sense, for the government to back the banks with the kind of equity backing that was needed at that point, the government finances had to be impeccable. And so the UK had to move towards more austerity than other countries simply because of the size of the banking system it was ensuring. So one reason to regulate is because the authorities, to some extent, have additional powers, and those additional powers essentially are gamed by the banking system. We know that you will intervene, therefore we take additional risks, right? It's never so explicit, it's more implicit. Because there is an expectation of intervention, the price of bank liabilities stays high, or the spreads for the banks don't blow out. So the expected liquidity support or the central bank put, for example, is a reason why, in fact, banks can go further out on a limb, take on more leverage. In a previous crisis, it was deposit insurance. If you remember the savings and loan crisis, the savings and loans were underwater because Chairman Volcker raised interest rates to 18%. They had long-term assets, short-term liabilities. They were deeply underwater as a result. What did they do? Because they had deposit insurance, they issued deposits and invested in very risky assets. This is the traditional gambling for resurrection. And what was initially a $25 to $50 billion hole in the banking system became a $200 to $300 billion hole that had to be filled in. So that's an example, again, where you anticipate intervention by the authorities and you take more risk, the traditional moral hazard. So these are all forms of intervention, of regulation. These are all reasons to regulate. In terms of the specifics, how do we actually regulate post-crisis? One of the most important areas of focus has been capital requirements. Now, ask regulators why capital requirements matter, and you get a variety of answers. Okay? I would say there are probably three important answers that one hears. One is simply that governance by equity, because the equity holders have so much at stake when they put their money into the bank, they have more incentives to protect that equity by being much more careful about the risk the bank is taking. So by requiring a lot of capital into the banks, the equity holders are going to monitor the banks more carefully. Is this reasonable? I think the reality is we've seen very little signs of equity holders monitoring the banks carefully, at least in the lead up to the crisis, right? A lot of the banks had boards that were basically composed of people who weren't particularly knowledgeable about finance. Some of them had long careers in public service, but rarely did they ask the right questions. What risks are you taking? Why are you taking these risks? And should you be dialing back on risks? I'm not saying every board was like this, but a fair number had difficulty. In fact, there was a famous German banker, Karl von Furstenberg, who basically said shareholders are stupid and impertinent. Stupid because they give the money to the banker to do as he wishes, and impertinent because they demand a dividend in return for their stupidity. So, I mean, this was a early 20th century German banker, but I think to some extent you could argue that implicitly this was the view of bankers running into the leading up to the crisis. I'm not saying, I'm sure they've all changed since then, but it certainly is a view that was there once upon a time. And if you look at the Lehman bankruptcy, I mean, clearly Lehman did raise some equity, but it's not clear that it dialed back on the risks it was taking. And ultimately, what closed Lehman down was not the equity holders, but the debt holders who ran on it. And so it's not clear that equity necessarily performs a better sort of governance function than debt. Sometimes debt itself preserves the value by putting an end to the firm at an appropriate point. I think the second and the third reason that the regulators will cite are more important. On the one hand, your capital gives you a budget constraint for risk. That is, you're allowed to spend only so much on risk taking. If you want to do more risk taking, you've got to go out and raise more capital. And that budget constraint is something that the regulators can monitor, which offers the regulators some comfort that there's some backing for the risk taking. And essentially, this leads to the third reason. It is a kind of loss absorbing buffer. That capital is a loss absorbing buffer. It's not that the equity holders monitor the bank any better. It's not that they force the bank to take less risk, but it's a buffer which protects the public from the actions of management. And to the extent that you worry about the bank, you ask the bank to replenish that buffer or increase the buffer, the prompt corrective actions that are taken. Now, there is a debate in academia. Some of you may have read Marty and Helwig's book, The Banker's New Clothes. They have a view that, this whole idea that banks should issue short-term demandable debt is all mistaken. That essentially all of intermediation can be done by equity financed banks. So let's get rid of all the financial system risk by asking banks to finance totally with equity. Have 100% capital for banks. All this nonsense about banks complaining when you raise capital beyond 10% is sheer nonsense. They don't really understand finance, and it's a problem. That's one view. There's another view, people like me, who believe that there is a rationale for banks issuing demandable deposits, and that demanding more and more equity means there's a greater buffer, but because that buffer doesn't exercise much control, effectively it makes the bank over time lose more value for the investors, and so to some extent there's a trade-off. Demand too much equity and there's very little sort of loss prevention in the banks. Too little equity and the banks themselves become fragile and get run very quickly. So there is a trade-off, there's an optimal amount of capital. We don't quite know where that optimal amount is, but we're probably pretty much where it should be at, with all the TLAC, this, that, we're pretty much where it should be for large banks. Certainly, we should check over time to see whether it should be higher or lower, but demanding 100% capital of banks is probably not reasonable. On the liquidity side, we have post-crisis the net stable funding ratio and the liquidity coverage ratio. One of the big questions that is raised is, do we really need two of these ratios? Effectively, when you combine them, it boils down to asking that we have a net short-term debt ratio. On the one hand, we have assets which are very liquid. On the other hand, we have liabilities which are very short-term. Collapse it into one requirement, a net short-term debt, and say that it can't be beyond certain amount. That certainly is a proposal by my colleague Anil Kashyap. We've done other forms of micro-prudential supervision and stress tests. Now, the supervision and stress tests were, the stress tests I think were very important in the US in 2009, essentially because they conveyed to the broader public that US banks were relatively safe now, and the authorities had gone into the details and assessed them, and therefore there were no walking wounded out there. The system was safe. And you can date the US recovery from about the time the stress tests were done, essentially giving an all-clear signal to the public saying, we've asked the banks that were in trouble to take appropriate amounts of capital, the rest are okay. I think that is a very important effect of the stress test. However, increasingly, as we move away from the crisis, the stress test is often being used as an early warning signal. Can we tell whether these banks are in trouble by testing against scenario A, B, C, D? And I think Claudia Borio at the BIS, and it's a view that I agree with, basically saying, trying to figure out whether these banks are going to weather the next crisis is going to be very difficult, because a lot of things come at you from different sides, and you're rarely going to have the scenario which actually mirrors the actual crisis. So using it as an early warning system may actually give you a false sense of comfort. It's better to use it as an all-clear signal that the system is working. Finally, I think we are going to regulating bank structures. We had the Volcker rule in the 1930s. We had the Glass-Steagall Act. We have a variety of ways to reduce certain kinds of bank activities. I mean, typically, these are pretty drastic forms of regulation. And what happens is that because you're regulating so strongly, there is a pushback over time that builds up, that perhaps you're over-regulating. The problem with that pushback is it tends to gain a momentum. And once it gains a momentum, it pushes back against reasonable regulation also. I'll come to that in just a second as I talk about who regulates the regulator. Basically, I think we should also think about regulatory incentives. Why did we sort of fail on the job before the financial crisis? If you remember, the classic role of the regulator, according to William Chesney Martin, a chairman of the Fed, was to take away the punch bowl when the party gets going, right? Unfortunately, many regulators don't have the political independence to take away the punch bowl when the party gets going. Because it means saying, nothing's gone wrong yet, but I fear things are going to go wrong, so I'm going to put constraints in the way. There are many forces which push against this, including industry associations, and so on. So taking away the punch bowl when the party gets going morphed into the new central bank doctrine. We don't know when the party actually is on, but when it breaks up and the punch bowl gets broken, we'll pick up the pieces. That became the Fed doctrine, right? We cannot stop a bubble, but we can certainly pick up the pieces. That was an ex post rationalization after the bubble of 2001, and the Fed did very well in reviving the economy. The problem was the crash of 2008 essentially broke the financial system into smithereens. Very hard to pick up the pieces after that, and we spent 10 years trying to pick up the pieces since then. So there is something to be said that leaning against the wind is also an important function of the central bank. You can't just say, I'll pick up the pieces once it actually breaks down. And you can't exhibit forbearance because the forbearance essentially means that the problem really goes. So what we have to guard against as regulators is what one might call pro-cyclical regulation. We liberalize into the boom because the old regulations were too tight. We liberalize and the party starts getting going, and we don't stop the party, and once the party breaks up, we essentially overregulate. And once we overregulate, we create the conditions for the deregulation and the boom once again, because everybody sees we have overregulated and the unwinding of the regulation starts. It used to be these regulatory cycles were long. We regulated in the 30s, we deregulated in the 80s. Today, we are deregulating what we did 10 years ago. So the regulatory cycle has become much shorter, and that is why I think it's very important to be much more stable in our regulation. Don't overregulate if you can. Be very careful about doing too much regulation, which protects you from having to unwind the regulation when the pushback comes from the public. Let me, I think at this point we're meeting into time that Ravi and I should spend on the stage. Let me end with one last point, which is, should monetary policy address financial stability issues? And this is a big current debate. On one side are those who believe in the pristine, pure inflation targeting framework that many central banks have adopted, and basically say, in this kind of framework, financial stability is not a big factor, and furthermore, monetary policy has little effect on financial stability. Essentially arguing in these bubbles, the rate of price appreciation is 10-20% a year. What will a 0.5% or a 1% increase in interest rates do? It's not going to diffuse the bubble. So monetary policy has very little effect. The flip side argument, often exposed by the BIS, is that monetary policy does have effect. Even if prices are going up so strongly, if you say that you are going to lean against the wind, the prices do recognize that. Liquidity does recognize that. And as liquidity gets curtailed, the bubble also gets curtailed. So there is a value to leaning against the wind. A second argument by the monetary side is, if you ask me to look at financial policy along with this, it overcomplicates monetary policy setting. After all, we have one instrument, the interest rate, and if we have 3 or 4 targets, it complicates matters, complicates communication, you don't know which target I'm aiming at. The response, of course, is that it should be part of any bank's medium-term inflation target. If you think there's going to be a financial collapse, it's going to affect growth over the medium term. Therefore, you want to ward off that kind of financial collapse. And really, you can't use targets and instruments as an excuse. When you have more targets than instruments, you basically have to muddle through. You have to trade off between, do I achieve price stability or do I achieve financial stability? Both are important, and both eventually lead to the same goal. The third argument of the monetary side is, don't ask me to use my monetary policy tools, use macro-prudential tools. And you use macro-prudential tools to deal with financial stability. I'll use monetary policy to deal with price inflation. Therefore, we restore the tools and targets, and we can both live separately and happily ever after. Problem, of course, is macro-prudential is relatively untested. And if one side is pressing on the monetary policy accelerator, the other side is desperately trying to curtail prices with macro-prudential tools, you get a mishmash that doesn't necessarily work together. And who wins? Almost surely monetary policy, because monetary policy works directly on every element of the entire economy. Macro-prudential typically works only on the banking system, can easily be bypassed. And that's why when Governor Jeremy Stein says monetary policy gets into all the cracks, I think he's absolutely right. That's why we should bring monetary policy into the discussion of financial stability. And having some coordination between regulators is important. So let me end. Growing recognition across the system that systemic regulation is key. Also a sense that competition between banks can impinge on financial stability. It's probably not a great surprise that some of the most stable banking systems have been Canada and Australia, which have relatively few banks and have more stability. Of course, monetary policy is not irrelevant to financial stability. Um, Finally, there is a risk that we have post-crisis of fighting the last battle very vigorously. We certainly can win the last battle, but what we need to do is win the next battle. And the point here is that banks, we have regulated them very strictly, but as a result, risk and talent is moving into the shadow financial system. Regulators are always battling a shape-shifting target. It's like playing whack-a-mole. Those of you who have done it, it's sort of the mole shows up different places. You keep whacking and you never actually do it. Another way of thinking about it is like a balloon. You press on this side, the other side bulges out, and you can never get it into the right shape. With new entities like fintech, we have to think about whether we are regulating appropriately and what more we need to do. One of the key questions we have to ask ourselves is the amount of regulation on banks appropriate? Or have we over-regulated banks, in which case we may have taken a key player out of the possibility of liquidity support as the next crisis sort of emerges. More broadly, we have to think of broad, robust, and timely regulation, dispensing with micromanagement, but also dispensing with over-regulating certain parts. I think having a thin layer across is probably the wisest for the complicated systems that we have. Let me stop there, and thank you very much for listening.